If you're searching why is AUD USD falling today, AUD USD forecast next week, or Australian dollar technical analysis June, this breakdown ties together China's iron ore supply shock, RBA rate hike pricing, and the live support and resistance grid to give you a clear Aussie dollar outlook. We've got gamma-style levels, institutional positioning clues, and a melt-up trap that could blindside late shorts. So if you're watching this right now, you're staring at one of the cleanest, most treacherous short-sided traps I've seen on the Aussie dollar in months. The herd is convinced, fully convinced, that the Aussie is heading straight to 0.68. And the daily chart, the 5-hour, the 1-hour, they all agree, strong sell. But the monthly chart is screaming something entirely different, and that is exactly where the money is about to be made. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end. I'm giving you 3 exact levels you can trade tomorrow. Right now, Australian dollar to US dollar is trading at 0.7047, and I need you to write this number down, 0.7146. If we get a daily close above 0.7146, the entire structure resets from bearish to bullish on the swing time frame. Everything I'm about to show you on the sell side gets invalidated instantly above that level. That is the pivot, the line in the sand. My instant market verdict. We are in a fading environment on the intraday charts, but we are fading into a longer-term demand zone that could trigger the ugliest short squeeze in weeks. The session bias is range-bound with a bearish lean until we test 0.7000, but the real trade is the reaction at that number. The herd is overwhelmingly short below 0.7100. I'm seeing retail sentiment north of 70% short, and that positioning is gasoline waiting for a match. When you have a strong monthly buy signal and a heavily short bias crowd, the path of maximum pain is not another leg lower. It's a violent snap higher that stops out the late shorts. But we don't fight the lower timeframes blindly. We use them to enter with precision. Let's go top down, from the monthly all the way to the 60-minute, because this is where the institutional footprints live. On the monthly chart, we are still in a strong buy structure. The MA200 sits way down at 0.6884, and price has been comfortably above that line for multiple months. That 0.6884 level is the bull's fortress. Every single monthly candle since March has closed above it, and the moving average ribbon is sloping up. That's why I say the monthly trend is strong buy. This is not a bear market on the higher time frames. Now move to the weekly. The weekly trend is neutral, and that's critical. When the weekly is neutral after a strong monthly buy, you're often inside a flag or a corrective channel. The 50-week moving average is around 0.7135, right near the cluster of resistance we are going to dissect. The weekly stochastics are trying to turn down from above 60, but they haven't crossed bearishly yet. That indecision is what makes the current daily strong sell so dangerous. The daily chart, however, is not ambiguous. It is a strong sell. Price is below the MA20 at 0.7152, below the MA10 at 0.7136, below the MA5 at 0.7114, and even below the MA100 at 0.7104. The entire daily moving average stack is bearish. We have a classic death cross formation brewing with the shorter averages all sloping south. The daily RSI is at 36.8, not yet oversold, which tells me there is still room to fall before we hit true exhaustion. The daily MACD printed a fresh negative histogram bar, and the bull-bear indicator sits at negative 0.0118, confirming the downside momentum is intact. Now here's what most traders miss. When I flip down to the 4-hour chart, the MACD is showing a hidden bearish momentum that is actually starting to slow its descent. The MACD line is minus 0.000, nearly flat, and the histogram is shrinking. That is the first subtle signal that the strong sell on the 4-hour is losing steam. The 4-hour stochastics are at 60.5, not in overbought territory but moving up. That tells me we might have one more push lower before a mean reversion bounce kicks in. The 5-hour and 1-hour charts both register a strong sell, but the RSI on the 1-hour is bumping along 36, flirting with oversold. I can see a positive divergence on the 1-hour RSI against price. Price made a lower low yesterday, but the RSI made a higher low. That is the hidden divergence that most traders will scroll right past. And it's the early whisper of a trap. Now, let's lock in the support and resistance grid that matters. On the resistance side, the immediate roof is 0.7090, which is yesterday's intraday high and aligns closely with the MA100. Above that, we have 0.7106 and then 0.7118, which is the MA5 and a prior swing low that now serves as a ceiling. The big kahuna is 0.7146, that's the weekly pivot and the breakdown point that, if reclaimed, would spark a serious short covering rally all the way to 0.7174. On the support side, the 0.7000 big figure is the psychological magnet. Below that, we have the April swing low at 0.6980, and then the fortress, the 200-day moving average at 0.6884. That is the floor for the entire monthly uptrend. As long as we hold above 0.6884 on any daily close, the monthly buyers are still in control, and every dip is a potential buying opportunity on a longer horizon. This technical picture doesn't exist in a vacuum. You have to understand what's driving the Aussie right now, because the Aussie is not just a currency pair, it's the China proxy. The Australian dollar is the world's purest risk barometer for the Chinese economy. Over the last 24 hours, we've had a cascade of data and headlines that explain exactly why we are at 0.7047. China's industrial profits came in sharply below expectations. Iron ore futures on the Dalian exchange collapsed nearly 4%, and copper is on a 5-day losing streak. This is not just a risk-off flutter, this is a genuine demand shock taking root in the market's pricing of Australian exports. At the same time, the RBA minutes from the June meeting retained a clear hawkish bias, noting that the board is still prepared to hike if inflation proves sticky. So you have a fundamental tug-of-war, a hawkish domestic central bank versus crumbling external demand. That's why the weekly chart is neutral and the daily is a strong sell. The market is repricing the external demand destruction faster than the RBA's rate path. Cross-asset linkage. The Aussie is moving tick for tick with the S&P 500 futures and with iron ore overnight. Right now, S&P futures are struggling below their 20-day moving average, and the VIX structure is starting to lift. If equity markets take another leg down, the Aussie will follow it straight into 0.7000. But here's the twist. The bond market is starting to price in a US slowdown, and that's dragging US real yields lower. Lower US yields, in theory, should support risk assets and the Aussie, but for now, the growth scare is overpowering the rate signal. Gold, the fear architect, is consolidating near its highs, which confirms that safe haven demand is robust. So the intermarket web is taut, equities falling, China demand rolling over, RBA trying to hold a hawkish line, and US yields offering some cushion. The 1 to 2 week directional lean is for a further grind towards 0.6980, but I expect a sharp rejection at 0.7000 that could trigger a short squeeze back to the 0.7090 to 0.7118 zone. The event that invalidates that entire view is a daily close below 0.6884. If the 200-day MA cracks, the monthly strong buy collapses, and you can start targeting the 0.67 handle. Here's where I want to trigger an interaction mine, because I need to see the collective pulse. Do you think the Aussie dollar breaks 0.7000 this week? Type yes or no in the comments right now. I'm tracking consensus, and I'll reference the split in tomorrow's video. Your input shapes the way I weight the institutional versus retail flow. Most people skip this next section. That's exactly where the money is made, so keep watching. I'm going to lay out 3 trade plans that turn this chaotic structure into a sniper-level execution framework. No theories, just precise entries, exact stops, and risk-reward ratios you can screenshot. Strategy 1. The sniper, the conservative approach. This is for traders who want to align with the dominant daily trend but avoid getting caught in the potential squeeze. We sell into resistance after a clear rejection. The trigger: wait for Australian dollar to US dollar to rally into the 0.7090 level, Then look for a 1-hour bearish engulfing candle closing below 0.7085. That entry gives you a confirmed short at 0.7085. Your stop loss goes above the consolidation high at 0.7118, giving you exactly 33 pips of risk. Take profit 1 sits at 0.7020, just above the psychological 0.7000 handle, locking in a 65 pip move. Take profit 2 extends to 0.6980, right at the April swing low, for a 105 pip gain. The risk-reward on this trade is 1 to 3.2. The setup is void if the daily candle closes above 0.7146. If that happens, the bearish daily structure is broken and you must exit the idea immediately to the sniper, conservative, entry, 0.7085, 1H bearish engulfing close below, stop loss, 0.7118 take profit 1, 0.7020 take profit 2, 0.6980 risk. Reward, 1:3.2 R invalidation, void if daily close above 0.7146 strategy 2, the active trader, the standard mean reversion play. This targets the bounce out of the 0.7000 zone before the larger bear trend resumes. You wait for the price to hit 0.7010, a level just above the big figure whereby stops often cluster. On a 15-minute bullish divergence in RSI, you enter long at 0.7015. Stop loss goes below the wick of the spike at 0.6990, a clean 25 pips risk. Target 1 is 0.7075, which is the MA100 in the first layer of resistance, providing a 60 pip reward. Once target 1 is hit, you move your stop to break even and set a trailing stop of 20 pips to ride toward target 2 at 0.7105, the top of the resistance cluster. That trailing rule protects gains if the squeeze suddenly fails. The risk-reward from entry to first target is 1 to 2.4. The setup is invalidated if 0.6980 breaks on a 4-hour candle close, because that signals the 200-day moving average is under threat and the bounce play is off the active trader, mean reversion, entry, 0.7015, 15M bullish RSI divergence, stop loss, 0.6990 take profit 1, 0.7075 take profit 2, 0.7105. Trailing stop 20 pips after TP1, risk, reward, 1:2.4R to TP1 invalidation, void if 4H candle closes below 0.6980 now. I want to stop right here and get another pulse check. Type your Australian dollar to US dollar range for tomorrow in the comments. Give me your high and low prediction. Let's see who's aligned with the technical grid and who's about to get trapped. I'll highlight the most accurate tomorrow strategy 3, the aggressor, the high-risk momentum chase. This is for traders who can lose small and manage risk aggressively. You short at market here, 0.7047, on the assumption that the intraday strong sell momentum continues without a pullback. Your stop goes at 0.7065, just above the 1-hour MA5 and the last minor swing high, giving you an ultra-tight 18 pips risk. Target 1 is 0.7000, a 47 pip shot. Target 2 is 0.6950, a level that opens up if the monthly buyers start to panic. Once 0.7000 is reached, you must tighten your stop to entry or partially take profit because the squeeze risk skyrockets at that psychological floor. This setup is only for those who understand that chasing a strong sell trend near a major support carries whipsaw danger. If the 5-minute chart prints a bullish engulfing candle above 0.7055, you scratch the trade instantly. Do not hold this through any China headline surprised the aggressor, high risk, entry, 0.7047, market sell, stop loss, 0.7065 take profit 1, 0.7000 take profit 2, 0.6950 risk, air reward, 1:2.6R to TP1 invalidation, 5M bullish engulfing above 0.7055, exit. Immediately risk management pulse. Never risk more than 1 to 2% of your capital on any single idea. No positions through high-impact news like the RBA minutes follow-up or China industrial data. Stops are non-negotiable. This is exactly how you survive to trade the next big move. The single most critical level for the next session is 0.7000. Every algorithm, every option barrier, every momentum trader is watching that number. A clean break and 4-hour close below 0.7000 opens the door to 0.6884, and that would be the trade of the quarter. A sharp rejection and a move back above 0.7090 flips the short-term structure bullish and triggers the squeeze. Tomorrow's wildcard is the Australian employment data preview and any overnight iron or stabilization. I'll be breaking that down in the S&P 500 and Bitcoin divergence video that's live right now. Tap the end screen to see how the liquidity tide is shifting across risk assets. Smash like if this gave you a clear, executable plan. Subscribe, hit the bell, and I'll see you in the next one, ready to catch the move before it happens.